Hey, welcome to this week's episode of Ask the Instructor. Every Wednesday, 12 noon Eastern Time, I myself, John Caruso, on behalf of the Tampa School of Real Estate, come live into your phones, your homes, your computers, your workplace, wherever it is that you're watching us, to help you understand the more technical side of real estate, understand the more technical side of real estate. And we're talking about something today that's not only important to know for your exam, but also something very important to know whether you're purchasing real estate yourself, whether you're buying it to live in the property for a second home, a vacation home, or you're looking to buy an investment property, or you're advising somebody that's looking to make one of these purchases, because they're going to want to know about this as well. And that's going to be the tax benefits of real estate. So real estate is loaded with tax benefits. And if it weren't for these tax benefits, it might not even be feasible to invest in property or even to buy a home for yourself. These tax benefits are really what make that possible. So there's a bunch of different things that are going to be tax benefits. We're going to be talking about benefits that tie in specifically to people that are just a homeowner. So whether this is they're buying their first home or they're trying to add a second home or a vacation home or some sort of additional home, that's going to be one set of benefits we're going to be talking about. And then we're also going to be talking about the benefits that tie in directly to investors. So if you're looking to invest in real estate, there's a whole different set of tax benefits for investors. So let's start off with homeownership tax benefits. And now, whether you're looking to buy a home yourself, it's great to know these, or if you're a real estate professional trying to help others purchase a home, these are the things you got to know like the back of your hand, especially when you're dealing with some people that are maybe renters and they're thinking about maybe purchasing a home. That's where you really need to educate them on the tax benefits they'll get for owning a home, because they might have some objections. So you talk to somebody maybe that's renting a home and they're thinking about maybe purchasing. They like the idea of purchasing a home, but they're trying to make sense of it. Or really they might be trying to not make sense of it, and that's where they come up with these objections of why they don't want to purchase a home. So one of the things that might be, can you turn off these lights too so we can get it a little less glare on the screen? So one of the big objections that you might get from somebody, okay, now you guys are going to be able to see good, is, yeah, I'd love to buy a home, and I love this low money down and all these other programs that are available to help me buy the home, but that's a lot of interest money. It's a lot of interest that I'm paying. I had somebody that bought a home, or somebody that's a friend of mine that's a renter or whatever it may be. They told me that, what do you want to buy a home for? You're just giving all your money to the bank. And so that's interest. And one of the hard facts of home ownership is interest. Interest is going to be a huge expense for purchasing a home. If you look at amortization charts, we've done an episode before on amortization. We might do another one to kind of refresh some of you guys' memories a little bit. But with amortization, your interest at the beginning of the loan is way up here, and your principal, how much of your loan balance you're paying down, is way here. So you'll start paying off your loan a lot faster, but not until you get to the end of the mortgage. At the beginning of the mortgage, you're paying almost all interest. So that could be a little bit of a deterrent, where you're talking about the equity buildup and so on and so forth, but it's going to take some time to build up that equity. But what's great about paying all that money in interest is that the interest is deductible. So interest is one of the biggest things that's going to be deductible, and that's going to definitely help you guys out for overcoming the objection or the complaint, whatever it is that you want to call it, that, hey, I don't want to buy a home because I don't want to have to pay all this interest. I'm fine just paying rent. At least I know the money's going away here. It's going to be mostly interest anyways, so what's the point? Well, over time, that interest will decrease, but while that's decreasing, and really for as long as you have interest, that interest is going to be tax deductible. Now, deductible basically means that you have to make so much money and all this stuff, and what we're talking about today is all the theoretical side of this stuff here. So if you're trying to implement this in practice, I never recommend doing your taxes on your own. I've done my taxes on my own a while back, and I was extremely misled by doing them on my own. So definitely recommend having a professional doing your taxes for you, because they'll be able to maximize all these deductions deductions that you could get. So interest is a huge deduction. This is going to help a lot of people purchase a home because now they know that, yes, I'm paying interest, but that's going to help lower your tax burden for your income taxes. So interest is a huge benefit. The next benefit that I want to talk about, and this goes back to another objection. So the government was really creative in finding solutions to these complaints and these objections that people had, whether that's lobbying efforts or whatever reason why these are part of the tax code. But interest is a big thing because that's a big objection. But another big objection is property taxes. Because even after your loan is paid off, or even if you paid 100% cash for the property and you don't owe any money and you don't have any interest, you're still going to have property taxes. Unless you're maybe a church or a nonprofit, that's maybe the only time you're not going to have property taxes. But for the common homeowner, property taxes are going to be a big expense. And again, you might be talking to somebody who you're trying to convince, hey, you should buy a home, and you might have already kind of overcame this interest aspect of it here, but maybe they're like, oh, well, what about the property taxes? I have to pay all this money in property taxes, and then I'm going to have to pay forever. I'm already paying income taxes. What do I want to pay property taxes for? The good news is property taxes are also another deductible expense. So property taxes are a deductible expense. We have our interest. It's going to be tax deductible. Property taxes, also tax deductible. So these are two of probably the biggest benefits to talk to somebody who's new to home ownership, somebody who's maybe been renting property that's thinking about purchasing. And if you're thinking this isn't something you should know, you absolutely need to know it, because right now we're at like the peak of the rental market. And really that could go even higher, but we're at some of the highest rental ratings, the highest rental percentage, the highest percentage of renters versus owners than we've had in decades, if not all time. I don't have the exact statistics, but we're extremely high, and that's because there's a lot of hurdles to home ownership, but some of these hurdles are easily overcame. Yes, there is interest, but that interest is tax deductible. Yes, there are property taxes, but those property taxes are also tax deductible. So these are huge, and we're going to be talking about the investment side of this, because right now we're just dealing with home ownership, if you can make out my lovely handwriting up here. So right now we're just dealing with home ownership tax benefits, but interest and property taxes, those tie into the investment side as well, but we'll talk about that more later in the show. Now, another big benefit is going to be, and now this is one that maybe only applies. So these two, both of these apply all the time whenever you're buying property, pretty much investment or actual home ownership, you'll get these two deductions. Now, if you're a first-time home buyer, again, tapping into this rental market, and you got to look up some of the specific definitions based on what program you're trying to categorize somebody as a home buyer, a first-time home buyer, but this typically doesn't mean that they've never purchased a home before. It just means they haven't purchased a home in so many years. So a lot of people can be classified as a first-time home buyer even if they've actually owned a home before, as long as they haven't owned a home within so many years. That definition may vary based on the program, so definitely look into the details on that. But as far as what we're talking about here is if you're a first-time home buyer, so this goes back to solving another objection, overcoming some sort of problem. We talked about them saying, okay, yeah, there's the interest I don't want to pay. Okay, interest is tax deductible. But what about property taxes? I don't have to pay property taxes. Property taxes are tax deductible. Now, for a first-time home buyer, another problem you might have, imagine you're talking to somebody, I'm sure you know somebody that's a renter, maybe you have a client that's a renter that you're trying to convert into a homeowner, and they might be saying, hey, look, I don't have enough money for a down payment. I don't have enough cash to put down in the property. So if they're a first-time home buyer, not only are they going to be able to tap into loans with 3.5% down, 5% down, sometimes even no money down, but when they do need to come up with some money, whether it's for the down payment, closing expenses, whatever it may be, they can make a penalty-free withdrawal from their IRA. So they're able to make a penalty-free withdrawal from their IRA. Now with this stuff here, especially if this is new to you and you're a real estate professional, or maybe you're a homeowner watching this and you're trying to figure out maybe some of the details of this here, get with a good lender, get with somebody who's going to help you work in the transaction to get this all accomplished, because there are some details that go along with this. There's some limits and things like that, but it's your job as a real estate professional when you're working with somebody who's a potential home buyer, they're wanting to buy a home, but there's these obstacles they have to overcome, is say, hey, there might be some ways around it. There's a first-time home buyer exemption. If you have some money in your 401k, we might be able to use that towards the purchase of your property. Let's find out more about that. So your basic job is to kind of help point them in the direction and guide them to the appropriate person, the appropriate accountant, the appropriate lender, whoever it is that's going to get more detailed and nitty-gritty with these types of things here. So the first-time home buyer is another big benefit because normally if you want to withdraw money from an IRA, you're going to be hit with huge tax penalties. There's huge tax penalties if you take that money out before retirement age. Now most people, they're going to want to buy a home before they retire, so that's what allows for this first-time home buyer to make a withdrawal without any sort of penalty. Now there's another one here that I'm going to talk about. And now this has to go maybe with the sale, because maybe you're talking about some of the benefits of home ownership with them, and you're saying, hey, look, you're going to be able to deduct the interest, you're going to be able to deduct the property taxes, and since you're a first-time home buyer, we're going to be able to tap into your 401k to use some money for the down payment. But what's also great is you're going to get this equity buildup in the property, and when you go to sell your property, this equity that you've built up, as long as this is your principal residence, is going to be excluded from capital gains. So that's our next benefit here, the capital gains exclusion. So the capital gains exclusion, this one is probably one of the, between these two, these are two of the most specific ones that apply here. So with the capital gains exclusion, this has to be your principal residence. This has to be your principal residence, and the rule is that you have to have lived in the property for at least the previous 2 years to claim this as a principal residence. But this capital gain exclusion, this is really probably the biggest benefit out of all this here, especially if you're being maybe a little bit more speculative in the purchasing of the property and kind of trying to get in the property at the right time and get out at the right time and make some good money in between. With the capital gains exclusion, there's two numbers you want to know. $250,000 or $500,000. So now these two numbers here, these are your exclusion amounts. And what the difference is between these two is how you file your taxes. If you file your taxes as a single taxpayer, whether it's you're married and you file single, you're single and you basically have no choice other than filing single. If you file your taxes single, you get a $250,000 exclusion from capital gains. If you file your taxes jointly, it's $500,000. So what that means is you could make up to $500,000 in profit on the sale of your principal residence and have to pay $0 in taxes. And that's huge. This is one of the easiest ways to kind of accumulate wealth. You talk to a lot of people that are extremely wealthy, and capital gains probably comes up in the discussion somewhere along the lines. And this is probably one of the most significant benefits of the capital gains tax code is if this is your principal residence, you could sell that principal residence, and if you're filing your taxes jointly, up to $500,000 can be made in profit. Now, when we come back, we're going to do some calculations on this capital gains exclusion, because this is definitely one that you're going to want to know how to calculate out to see how much really room you have. Most cases, unless you're dealing with multi-million-dollar property, you're not going to tap out that $500,000. You could, but we're going to take a quick commercial break. When we come back, we're going to do some math on the capital gains exclusion. I'm John Chrismo. Don't go anywhere. Have you been thinking about starting a career in real estate? Enjoy an entrepreneurial lifestyle that allows for schedule flexibility with unlimited income potential. In real estate, the sky is the limit, and what you put in is what you get out. Learn more about a career in real estate at tampaschool.com. Tampa 10 years ago is nothing like Tampa today. It's changed dramatically over those years, and that's what's really transitioned this to be the number one healthiest housing market in the entire nation. Tampa 10 years ago is nothing.
Do you want to incorporate studying for your real estate exams into your busy schedule? Now you can review the key topics you need to know to pass your class and state exams with our MP3 audio review. Simply pop in your headphones or connect to your car to reinforce crucial information while you exercise or drive. Listen to the first unit for free at mp3audioreview.com. That's mp3audioreview.com.
Hey, if you liked the show today, be sure to hit like and subscribe and post your comments. Thanks so much for watching. Hey, welcome back to this week's episode of Ask the Instructor. I'm John Christman. This show is brought to you by the Tampa School of Real Estate. If you're interested in starting or enhancing your career in real estate, make sure you give us a call. Make sure you check out the website listed below. It's tampaschool.com or 813-928-0106. But what we're here to do today is teach you about the technical side of the real estate industry. And what we're talking about today is tax benefits. Tax benefits for whether you're a homeowner or an investor. There's different tax benefits that are an absolutely must on the need to know, whether it's you're just trying to take the exam to pass the exam to get your real estate license, or you're thinking about buying a property yourself, or maybe you already have your license and you're trying to help turn a renter into a home buyer by informing them and educating them of these tax benefits that they're able to get from owning a home. So we've got interest. That's a huge deduction because especially when you're first starting out with a loan, you're paying almost all interest on your loan payments. Very little amount actually going to decreasing your loan balance. That comes much later in the mortgage. You have the property taxes. Property taxes are another huge expense that you're going to have owning a property, but these are tax deductible. The first-time home buyer, you get a penalty-free withdrawal from an IRA. So normally you get penalized at really, really steep rates for taking out money from your IRA when you're taking that out before retirement age. But if this is for the purchase of a home for a first-time home buyer, you get an exemption with that. And the big one, and this is the one I said we're going to do some math on, is the capital gains exclusion. So the capital gains exclusion says that when you sell your property, now, if this wasn't your principal residence, you'd be taxed at capital gains tax rates, which capital gains tax rates are already some of the lowest tax rates, pretty much the lowest tax rates that are available for money that's being made. So capital gains is already a really low rate, but when this is your principal residence, meaning that you've lived there for at least the past 2 years. Now, if you've lived there for less than 2 years, you want to talk to an accountant because there might be some kind of trickery you can maybe factor into this here, or some ways to kind of like, pull some strings and work some of this stuff. But to get the full exemption, basically, because you're getting a smaller amount of the exemption if it's less than 2 years, you have to be there for at least 2 years to claim these exemption amounts. But if you're filing your taxes jointly, that's up to $500,000 you're able to claim. So let's do some quick math here. So just so you can kind of wrap your head around this, because we're talking about $500,000 of profit, basically. Not $500,000 of difference in sale prices that you bought for $100,000, you sold for $600,000. Yes, you'd still wouldn't have to pay capital gains taxes on that, but it's going to get even steeper than that for the benefit that you're getting. So let's say that you purchase a house for, let's say about $250,000. Let's make it $300,000. Keep it round numbers here so we don't have to whip out the calculator. So let's say you've got this $300,000 house that you purchased. Now, on top of this $300,000, let's say that you put $50,000 into the property. And, maybe you had, let's say about $10,000 in closing cost. And let's say you put $90,000 into the property here. So let's say you put $90,000 worth of improvements to the property, what's called a capital improvement with tax in tax lingo. $10,000 you had in closing cost. So altogether, so far your cost ends up being about $400,000. So you've got $400,000 in cost. Now when you go to sell the property, let's say you sell this property, and let's really kind of flex the difference of this here. Let's say you sell this for $1 million. So you bought this property for $300,000, you put about $90,000 into it, spend about $10,000 in closing costs and other miscellaneous expenses that are tax deductible for the capital gains, and then you end up with a total cost of $400,000. When you go and sell this property for $1 million, let's say on this $1 million you end up paying about, let's say about $60,000 in commission. Or we'll call them brokerage fees. And let's say maybe, we've got another, let's say about $40,000. Again, I'm trying to keep these numbers simple here. So let's say we got about another $40,000 in closing cost and other types of expenses. That's probably going to be really higher than what it would normally be. But in this scenario here, what we would do is, so we take out this $1 million or $60,000 or $40,000, so we end up with $900,000. So $900,000 is what we had sold the property for. Once we take out these expenses, we then subtract out our cost of $400,000, and what we're left with is $500,000. So as long as the homeowners of this property file their taxes jointly, they wouldn't have to pay a penny on the capital gains of this property. As long as this is their principal residence, they've lived there for at least 2 years, they're filing their taxes jointly, they wouldn't owe any capital gains taxes in this scenario here. The reason is you're able to add up these additional costs. So it's not just the sale price minus the previous sale price. It's not $1 million minus $300,000. That would be $700,000, which if this number were $700,000, then only $500,000 or $500,000 would be exempt, and that means $200,000 we would have to pay capital gains on it. But what the cool part of this is that you're able to factor in these other expenses, the improvements, the closing cost, various expenses. There's certain ones that can be used and whatnot. Closing expenses are definitely one of them. But you're able to factor in these other expenses that you have, the cost of the sale, the cost of acquiring the property, and the cost of selling the property to really kind of get yourself down. And you could see this is a huge disparity between these here. I mean, unless you've had a market that's basically kind of skyrocketed very quickly, or you've owned this property for a very long time, you probably aren't going to see a $300,000 property turn into a $1 million property. But if that does happen, and if it played out just like this scenario here, if you file your taxes jointly, no capital gains taxes. And you don't even have to go and turn around and put this into another property. Don't get this confused with what you're probably thinking of, what's called a 1031 exchange or a tax-deferred exchange, which is another way, because this only works for your principal residence. We'll talk about that tax-deferred exchange in just a little bit here, but with your principal residence, you could take this $500,000 if you want to go buy an RV, or you want to buy a boat, or you want to go pay for your kids' education, or whatever it is that you want to spend that money on. That money is basically yours with no taxes. Again, as long as this is your principal residence. So that's a huge exemption there, that capital gains exemption. But now, real quick, before we turn into and switch gears into the investment side of this here and what type of expenses you're able to deduct for investment property, what I want to talk about is your deductions that you cannot use on your principal residence. So these are going to be some of the things we're going to talk about on the investment side that we're not going to see on our principal residence. So we've got a couple of them here. One of them is operating expenses. So operating expenses, and let's put a big not deductible up top here. So operating expenses are a big one that are not going to be tax deductible, but again, on your principal residence. We're going to talk about investment property. Operating expenses are deductible on an investment property, but if this is your principal residence, your cost to mow the lawn, or for pool maintenance, or for improvements you're making on the property, or whatever it is that's an operating expense, these are not tax deductible if this is your principal residence. Now, one of the other ones I want to talk about here is a capital loss. So a capital loss is not deductible on your principal residence. So if you lose money If you buy a property for $1 million and try to sell it for $300,000, if this is your principal residence, you cannot declare a capital loss. That's something you're going to be able to do with investment properties, but you cannot do that with your principal residence. And the last one, and this is probably the biggest benefit for investment property, is called the depreciation deduction. So the depreciation deduction, what that allows is when you have an investment property, this allows you to deduct money every single year that you own the property for depreciation of the property. And the kicker is you could get this deduction even if there's no depreciation actually occurring on the property. So this is a huge benefit. This is what creates what's called a tax shelter. You might have heard that word tossed around before of a tax shelter. A tax shelter is when you're able to shelter your income from taxation due to deductions that you get. And if you're getting more depreciation deduction, because this is a predetermined, pre-calculated amount basically that you're eligible for, not based on actual deductions, this is a huge way to create a tax shelter with that depreciation deduction. So if you want to learn more about the operating expenses, the capital gains, or the depreciation deductions, stick around because these are all three that are exclusive to investment properties, not for your principal residence, but if you're investing in real estate, that's where you're able to claim some of these benefits. So we're going to take a quick commercial break. Don't go anywhere. I'm John Crismo. You're watching Ask the Instructor.
Have you been thinking about starting a career in real estate? Enjoy an entrepreneurial lifestyle that allows for schedule flexibility with unlimited income potential. In real estate, the sky is the limit, and what you put in is what you get out. Learn more about a career in real estate at tampaschool.com.
Tampa 10 years ago is nothing like Tampa today. It's changed dramatically over those years, and that's what's really transitioned this to be the number one healthiest housing market in the entire nation.
Do you want to incorporate studying for your real estate exams into your busy schedule? Now you can review the key topics you need to know to pass your class and state exams with our MP3 audio review. Simply pop in your headphones or connect to your car to reinforce crucial information while you exercise or drive. Listen to the first unit for free at mp3audioreview.com. That's mp3audioreview.com.
Hey, if you liked the show today, be sure to hit like and subscribe and post your comments. Thanks so much for watching. Hey, welcome back to this week's episode of Ask the Instructor. Every Wednesday at 12 noon Eastern Time, we come to you live into your phones, into your homes, into your TVs, into your mobile devices to help you understand the more technical side of the real estate industry. That's every Wednesday, 12 noon Eastern Time. And if you haven't subscribed already, make sure you subscribe so you can learn this stuff that's going to help you excel in the real estate industry. It's going to help you buy a home. It's going to help you invest in real estate. Knowledge is the key in the real estate industry. So make sure you're liking, make sure you're subscribing, share this with your friends and family because we're not here to keep the knowledge all locked in. That's why we do these shows for free, to spread the knowledge and the good word of real estate out there. And what we're talking about today are the tax benefits that are associated with real estate. Now, what we were talking about in the previous segment was that these three are not tax deductible on your principal residence. So you can't claim an operating expense as a deduction on your principal residence, you can't take a capital loss, and you can't get the depreciation deduction on your principal residence. But if this is an investment property, you're able to tack on all three of these, which are huge. You definitely want to understand these tax benefits that you get. So first one we've got here is operating expenses. Now this one, if you understood the capital gain stuff that we talked about here, these operating expenses kind of make the same sense basically because you're only going to be taxed on profit that you actually get. So with our operating expenses, if you've taken one of the classes with us, you probably remember the income funnel. So the income funnel, we've got three types of income: the potential gross income, the effective gross income, and then what's called the net operating income. So you've got these three levels of income, PGI, EGI, and NOI. The NOI, the N stands for net operating income. And with net operating income, the word net, N-E-T, basically means not, meaning not expenses. So net income, net operating income, means our income after expenses. So ultimately, it's this NOI, the net operating income, that's taxable. You're not going to get taxed on your effective gross income. Effective gross income is how much income the property is effectively generating, how much it's really making after you take out your vacancy and collection losses and whatnot. But this is a gross number. The word gross means that expenses are still included. And if you're an accountant or if you're an investor, you'll probably think that number's gross because it doesn't tell you the real story. The real story is our net income. That's going to be after expenses. Gross income means that expenses are still factored in. That's just a gross number because it's not really very telling. So that's the way you could remember gross income versus net income. Gross is gross because it still has the expenses. Net is not expenses. You just turn the E into an O. So your operating expenses that you have for the property are tax deductible. So when you're having a property that, let's say, we'll do a little bit of an oversimplification on this again, just to make sure you guys get the important concept of the tax deduction here. Let's say that your property is effectively generating, let's say it's making 50 grand a year. Let's say you've got an investment property and your rents total out to $50,000 for the year. That would be our EGI number, our effective gross income. But now let's say you have some operating expenses to operate this property. Let's say that it takes you maybe about $30,000 to operate this property. What we're going to be doing basically is subtracting this out. That's our expenses. So we've got $50,000 that we're bringing in from rent. We've got $30,000 that we're losing from expenses for the year. So we end up with $20,000 of NOI. And that $20,000 is going to be taxed as income. Now, what you need to do here to really kind of minimize this, so you're able to claim these expenses, which this isn't a huge benefit because you'd think you'd be able to claim these expenses, but when we think about your principal residence, you can't do these types of things. If this is your principal residence, you get some other benefits like the capital gain exclusion, but you don't get these benefits here. What you might be able to use to offset this, so this was our operating expenses here that gave us the $20,000, that's our actual taxable income, the NOI. What you could probably do is claim this depreciation deduction. So the depreciation deduction, this allows you to deduct a certain amount of money every single year as depreciation. And this, the important thing here to know is this is whether or not depreciation occurs. You could have the property completely maintaining value. You could have the property going up in value. It doesn't matter as to whether or not the value is actually going down or depreciating at all. There doesn't have to be depreciation occurring to claim the depreciation deduction. The depreciation deduction you get automatically, but again, only for investment property. We're talking specifically only about investment property here. So with the depreciation deduction, what you have to do is you take some numbers here. So what we're going to start off with is our entire property value. So let's say our property is valued at, let's say it's a $500,000 property. So $500,000 property. So we've got $500,000 of our total property value. Now with the depreciation deduction, there's this little rule that goes with appraisal, that goes with tax code for real estate. It's that land does not depreciate in value. So land, it can go up or down in value, but it's not due to depreciation. Depreciation does not occur with the land itself, so you never depreciate the land. What we have here is the entire property value factoring in the land and the building. So what we need to do is basically extract the building value out of this. And there's a bunch of different ways you could go about doing this. It could just be something as simple as, let's say, taking, let's say the building is 80%. And they might call that number what we're going to get to a depreciable basis. Depreciable basis is just the fancy way of saying what the building is actually valued at. So if we're going to take 80% of this $500,000, we're going to end up with a building value of $400,000. So our building in this case is worth $400,000. Total property is $500,000. And what we need to do now, and the tax code says, based on the type of property that we're dealing with here, if this is going to be a residential property, it's 27 and a half years. If it's non-residential, it's 39 years. So it depends on whether you're dealing with a residential property, which this is the lifespan of the property. So the IRS says a residential property is supposed to last 27 and a half years. A non-residential property, such as an office building or a retail plaza or something that's not where people live, is supposed to last 39 years. And based on what type of property it is going to change the amount of depreciation deduction that you get. You're going to get a little bit more deduction for a residential property because it's got a shorter lifespan. It's condensing those deductions across 27 and a half years versus 39 years. And the kicker with this too is these aren't going to run out. These don't run out once you own this longer than 27 and a half years or longer than 39 years. You're able to claim this again and again and again for as long as you own the property. It's called the straight line method of depreciation. So let's say this is a residential property here. So what we're going to do to calculate this out is we're going to take our building value, the $400,000, and divide this by 27.5. So we're going to take this $400,000, whip out the handy dandy calculator here. So 400,000 divided by 27.5, and we're going to get a depreciation deduction for the year of $14,545 and about 46 cents. You'd probably just round that to the next whole dollar. I'm not an accountant. I'm not pretending to be an accountant, so I don't know what the exact rules are for the rounding with that stuff there, but that's what the calculation comes out to. So let's just say we're going to round that down to 14,545. What that means is up here, going back to the income we calculated out earlier, we figured that we're getting $20,000 in income from the property, but this entire income isn't going to be taxable because we're taking out our depreciation and deduction here, so we're going to be able to subtract $14,545 from this NOI. And when we do that, when we take $20,000 and subtract out $14,545, we end up with a taxable income. So this is the only amount of income that's going to be taxed due to this depreciation deduction of $5,455. So that's a big difference. That's a lot less money that's being taxed compared to $20,000. $20,000 would carry a pretty substantial tax bill in relation to that $20,000. But now in relation to $20,000, if we're only getting taxed on $5,455, you could see the huge benefit that we're getting from this depreciation deduction. And if your income was only $14,545, that number would be zero, and you wouldn't have any taxes due on this property because you'd be completely deducted. All of your income would have been deducted from the property. And the kicker about this is that the deduction that you're getting for depreciation, you might have already spent some money up in the expenses. Maybe you already spent $10,000 this year on the roof, and that's an expense that can be factored in and deducted. But then on top of that, when you're able to claim this depreciation deduction, that just further kind of brings this down. And with this, it's a number that you're basically guaranteed to get every year that you own this investment property for as long as you own it. And it's based off of whatever the current building value may be. So that's the depreciation deduction. That's a huge, huge benefit that you definitely want to capitalize on when you're investing in property. But now there's one final deduction that we're going to talk about here that's specific to the investment property. And this is the ability to declare a capital loss. So with your principal residence, you can't declare a capital loss. If you lose money selling your property, the IRS basically says tough luck. And that's it. But now, if this is an investment property and you lose money selling the property, that's where the IRS has a different story. They're like, okay, well, you lost money in a business venture, so that is tax deductible. Let's not try to logic and reason why the tax code is the way it is. It's over 70,000 pages long, the tax code, so there's a lot of stuff in there that doesn't always make the most amount of sense. But anyway, so with this capital loss, our job isn't to try to understand why, it's to understand how to capitalize and maximize these tax benefits that are available. So for our capital, we'll call this capital gain and capital loss because they're essentially the same thing. So with the capital gains and capital losses, a capital loss is able to offset a capital gain. So let's say you've got two properties that you're dealing with here. You've got property A and property B. Both of these properties you purchased for $100,000. So you buy these two properties for $100,000. Now this year you sell these two properties and you sell property B for $125,000. So that gives you a capital gain of $25,000 because you purchased for $100,000, you sold for $125,000, so therefore you've gained $25,000. Which, if this were the case and there was no property A, or let's say we didn't sell property A this year, we would be taxed at the capital gains rates, which are already going to be lower than ordinary income tax rates, but we would still have to pay a tax on this gain of $25,000. So if we made $25,000 on this property in the form of a capital gain, and going back to what we talked about earlier with calculating the capital gain, you're still able to get all those expenses and everything like that worked in there to minimize this number if you do have a capital gain where you would have to pay taxes on it. But with investment property, what you're also able to factor in is called a capital loss. So let's say you take property A and you sell property A for, let's say, $75,000. So in this case, we have a loss of $25,000. We gained $25,000 on this property. We lost $25,000 on this property. That means our total net gain is $0. We have no money that would be subject to capital gains loss because any money that we made over here on the gain side, that $25,000 we gained was offset by the $25,000 we lost within the same tax year on the sale of these two properties here. Now, the key thing with this, to be able to work with this, and if this one was $20,000 that we lost, then we would only have $5,000 in gain. So this is able to offset, if not completely, partially whatever gains it is that you have received that year. Now, the key thing with this is both of these properties, A and B, they both have to be investment properties. If one of these is your principal residence, so let's say if property A was your principal residence, you made money on your investment property, but you lost money on your principal residence, you wouldn't be able to offset that with a loss on your principal residence because a principal residence is not allowed to accrue a capital loss. But if this is an investment property, you can get a capital loss. Just like if property B were a capital gain, you actually would be excluded from that capital gain if you're a principal residence. But since it's an investment property, you have to pay capital gains. There's no exclusion for capital gains on an investment property. Really, the only way you could get around that is if you want to go live in the property and claim it as your principal residence for 2 years. Then maybe you could get around that capital gain stuff, but talk to your accountant if you're trying to do some shady stuff like that. But ultimately, that's our capital gain and capital loss. So as long as these are occurring within the same tax year, and sometimes you can even carry these over and whatnot. What we're talking about the capital gain, there's actually one more tax benefit that I really want to share with you guys today, and that's going to be called a 1031 exchange, or what's also known as a tax-deferred exchange. So now with the 1031 exchange, or how I like to call it the tax-deferred exchange, and we'll do the little IRS, little like squiggly thing. I think it's something like that for like the IRS code. Something like a dollar sign. I forget what it exactly looks like. So this is section 1031 of the IRS code, and it's called a tax deferred exchange. The key word here is deferred. So this doesn't eliminate your capital gains taxes, but it does defer your capital gains taxes. So let's go back to that last property that we bought for $100,000. We sold for $125,000, and therefore we had a $25,000 gain. So looking at this, and this is one of the ones where it's definitely important that you know that this exists, because you can't do this after the fact. You can't go back in and retroactively do a 1031 tax-deferred exchange. You have to know that you're doing a tax-deferred exchange, a 1031 exchange, going into the sale of this property. So before you sold the property, you got to know that you want to 1031 it, that you want to put this tax-deferred exchange in place so you don't have to pay taxes right now on that $25,000 gain. And what the tax-deferred exchange says, basically, there's a lot of different rules you have to follow. So make sure you're dealing with a professional here. You actually are required to deal with a professional that's going to hold that $25,000 gain until you go and reinvest it into a new property. So you do have to have what's called a qualified intermediary. So if you don't know who a qualified intermediary is, or you want to find one, Google qualified intermediary for a 1031 exchange, and you'll be able to find a whole bunch of different organizations and companies that would be able to help you out with this 1031 tax-deferred exchange. But what this does is it says, okay, we're going to take this $25,000 in gain that you have, and rather than get taxed on it now, we're going to put this into a new investment. We're going to put this into a new investment and then take that new investment when this one gets sold, unless we do another 1031 exchange, which is absolutely allowed. You're going to have to pay taxes on it when you sell that one. But you're able to basically roll this into a new property without having to pay any capital gains taxes, because you're just deferring them to a later date. So that's the 1031 tax deferred exchange, which is a must know about if you're investing in real estate, because if you plan on making money selling your real estate, which I hope you're planning on making money with your real estate. If you're not planning to make money on your real estate, we need to have a different conversation. But if you're planning to make money on your real estate, when you go to sell it, unless you want to pay capital gains taxes at this point in this time right here, if you're just going to put this into another investment, there's no reason to pay capital gains taxes here, because you could put this into another property, you could put it into a storage facility, maybe some sort of business. Talk to your qualified intermediary and they'll give you more of the details on how to do all this stuff here. But a 1031 exchange is an absolute must know, whether you're an investor yourself or you're advising investors to help them with their property. But that's really kind of sums up some of the key tax benefits that you want to know about here. So whether it's you're buying a home yourself, you're investing in property yourself, or you're going to be advising somebody buying a home or advising somebody that's investing in property, you need to know about these tax benefits. If you guys haven't subscribed already, make sure you do that. Thank you if you've already subscribed. Thank you for liking. Thank you for sharing the stream. Share the stream, share the dream. So make sure you're following us, because every Wednesday we do shows just like this to help you understand the real estate industry, to help you pass your real estate exam, because pretty much everything we've talked about today is definitely fair game for being testable on your real estate exam. So make sure you know that stuff if you're trying to pass your exam, or again, if you're just trying to be successful in the real estate space, whether that's buying a home, investing, or advising others when they're buying and investing, you need to know this stuff here. But that's all I've got for you guys today. If you're thinking about a career in real estate, visit tampaschool.com. If you're studying for your exam, visit passfirsttry.com. Or if you don't like the internet and you'd rather call us in person, call us at 813-928-0106. That's 813-928-0106. Until next week, I will see you next Wednesday, 12 noon Eastern Time, for another episode of Ask the Instructor.
Have you been thinking about starting a career in real estate? Enjoy an entrepreneurial lifestyle that allows for schedule flexibility with unlimited income potential. In real estate, the sky is the limit, and what you put in is what you get out. Learn more about a career in real estate at tampaschool.com.
Tampa 10 years ago is nothing like Tampa today. It's changed dramatically over those years, and that's what's really transitioned this to be the number one healthiest housing market in the entire nation.
Do you want to incorporate studying for your real estate exams into your busy schedule? Now you can review the key topics you need to know to pass your class and state exams with our MP3 audio review. Simply pop in your headphones or connect to your car to reinforce crucial information while you exercise or drive. Listen to the first unit for free at mp3audioreview.com. That's mp3audioreview.com.
Hey, if you liked the show today, be sure to hit like and subscribe and post your comments. Thanks so much for watching.